Hi, everyone. I'm Pat Morris, the investment manager at Intention Financial Partners. I'm joined today by my associate, Andrew Abel. We're just going to go over with some of the stuff that's been going on in the market and some of the geopolitical risks and how they affect the market and your portfolio. I'm going to turn it over to Andrew to start.
Thanks, Pat. Yeah, this first slide here, we just want to go through a few examples of what geopolitical risk is. So I'm just going to highlight a few of the examples here. Last year in 2025, we were dealing with more of that tariff column there with the tariff talks in the first and second quarter of 2025. This year, what we're dealing with is on the energy and supply chain disruption due to the conflicts overseas between the U.S., Israel, and Iran. Uh, Shocks can drive short-term volatility, but it's important to stick with your plan and to avoid making those irrational short-term decisions. On this next slide here, what we want to show is markets don't always sell off due to geopolitical risk. So if we take a look here, the median sell-off is 17 days, while the time to recover is 16 days. And in most instances, markets were higher 12 months later. So
Yeah, and thanks, Andrew. And we've seen this slide before, or those of you who have been with us before have seen this slide. The stock market does have times where it ebbs and flows, and the flows go negative, and we have negative returns. So the size of the decline. So three times a year on average, you see a market decline of 5%. And the last one in this case happened in November. 10% or more is about every year to year and a half, and that happened last March. And so then every 3 years, you see about a 15% or more decline. And of course, we had that in a bounce back last April. So you do see ebbs and flows. But the one thing that is costly is panic selling. So obviously, it would be helpful to avoid the worst performing days and be in there on the best performing days. But as the chart on the right shows, interestingly, um, that the 10 worst days and the 10 best days overlap a lot or are in the same basic time frame. So if you see there, the best day performance was 10/13 of 2008, and 2 days later, the worst performing was 10/15 of 2008. So, slide goes to show that it's kind of the market timing is very tough because if you're out of the market, fully invested, as you see here, between January 1990 and present, would be about 11%. If you miss the 10 best days, you drop about 3% to about 8. So important to be fully invested for the long term. And this was, I thought, very interesting. For the last 90 years, we always talk about the S&P 500 average market, and it's between 9 and 10%. So we always say 9 and 10%. You've seen that quoted, but only two times has it actually returned between 9 and 10%. The other times, it's up or down a little bit more than that. So it's a long-term average. So it's going to generate returns, but it's for the long term, and you can't really pencil in a certain percentage in any given year. But it keeps a long-term mindset. And this is an interesting chart, and once you've probably seen before, but like through all the thick and thin, what the market has done through all the shocks. I mean, we're talking about the tech bubble, the global financial crisis, the COVID, April 2nd tariff rollouts. The market has continuously climbed. It goes up and it goes down, but over the long term, as you can see, that chart is upward sloping.
yeah, thanks, Pat. Just to build off of that, we just want to emphasize that there's many factors that impact stock prices in the short term, but if we're looking in the long run, stock prices tend to follow their earnings growth and fundamentals. So that's what we want to emphasize here. And this last slide here that I'll cover, just the importance of a well-diversified portfolio to reduce idiosyncratic risk. So a balanced portfolio, it won't always have the highest return, and it also won't always have the lowest return, but it creates a smoother ride throughout market fluctuations like we're seeing currently, and like we have over the past year with the tariff talks as well. So, and this just shows our belief in a long-term holistic approach during these volatile times rather than making short-term irrational decisions.
Thanks, Andrew. So, in wrapping up, what steps do we take, or how do we avoid overreacting? And it's obviously it's easy to feel anxious, and it's normal to feel anxious during market dips. But making impulsive changes only hurts the your long-term goals. And remember, your plan accounts for these fluctuations. We have diversified portfolios, like Andrew just was pointing out. We're across bonds, stocks, international stocks, real assets. So we have built a durable portfolio. So just, I think the goals are: check your plan. Make sure your investments still align with your goal and time frame. If your goal and time frame is long term, then you should be in riskier assets and that you feel comfortable with. Short term needs are covered. Cash and bonds are there to cover whatever short term cash needs are needed. Second is to stay focused on the long term. You're going to get swings like this, like we just said. 3 times a year it's going to be down 5%. I know it's uneasy, but the long term growth is the goal. And lastly, talk to your advisor. We can help you sort through any noise and stay grounded in what's going on. So we just wanted to kind of thank you for choosing Intention Financial. And we, just wanted to kind of come out and, give a little talk about how things are going in this market currently. So thanks, everyone.
Thank you.